Good day, everyone, and welcome to our webinar for May of 2023, the confidential report. I must apologize today. I've had a throat infection, so my voice may be a little rough and I might have to stop and cough at intervals. I apologize for that in advance, but hopefully we'll be able to get through it without any problems. So we begin as usual in America. We have now seen Silicon Valley Bank and Signature Banks fail in America, and now First Republic Bank has been obviously taken over by JP Morgan, and that was despite a $30 billion injection. The share price has dropped 97% in just a few weeks. And now I see that there are rumored problems with other banks, small banks, PacWest and Western Alliance, which may be in trouble. This kind of feels to me like the tremors that you normally get before a major earthquake. Of course, we all know that the Fed today, later on today, will probably push rates up by another 25 basis points. So far, they have increased rates 10 times by a total of 5% in just over a year. The full impact of these rate hikes is not really fully felt by the economy, and certainly the investing public is not yet discounting the full effect into the market. The banks that have failed were heavily invested in bonds, treasury bills. These are supposedly very secure assets, but when interest rates go up, bond prices fall. That's well known. They fall until their effective interest rate is equivalent to the new higher interest rates. Small banks face heavy client withdrawals, and if they also have asset prices like bonds that are falling, that is a recipe for trouble. They may be forced to sell those bonds at a loss in order to meet client withdrawals. A recent paper published by the National Bureau of Economic Research in America says that the market value of bank-held bonds in America is $2 trillion below their book value. In other words, the value that they're showing on their books for those bonds is too high by $2 trillion. This is obviously only a problem if depositors decide to withdraw, especially at the smaller banks which do not have the strength in their balance sheets. So we expect more small banks to fail in the coming months. And of course, there has also been a loss of investor confidence in the banking system, despite the government's very strenuous efforts to make sure or to try and persuade them that their deposits are safe. On your screen, you should see the S&P 500, the usual chart that I show. Wall Street ended last week in the grip of bullish buying sentiment. This was caused by the better-than-expected quarterly results from Standard & Poor's or S&P 500 companies. The economic news, on the other hand, was not good, but investors are taking a bad news is good news position. Bad economic news is seen as making the Fed more likely to pause, and that is bullish for shares. So when you get bad economic news, investors take the attitude, well, that's going to make the Fed pause or pivot in their rate hiking cycle, and obviously that's good for shares. So it has a kind of paradoxical positive effect. GDP growth in America in the first quarter was 1.1%. much less than the forecasted 2%. Yet this is seen as good news by investors for the reasons which I've just explained. But it supports our view that the US economy will probably enter a recession later on this year. High and rising interest rates are causing a drying up of credit facilities. Companies are finding it hard to refinance, and when they do manage to refinance, they're finding that they have to pay a much higher interest rate. Inevitably, this will impact on consumer spending sooner or later, and ultimately, obviously, also job creation. Gradually, but with increasing speed, the effects will proliferate through the economy. in March month, consumer spending was up by 3.1% year on year. But that excludes the effect of inflation. Real spending is actually negative. For the 12 months ending March, all items price index was up 5%. Shelter, in other words, the cost of rent in your house, and food were up 8.2% and 8.5% respectively. That shows that inflation is far from being under control. Jobless claims were 230,000 in the week ending 22nd of April. Analysts were expecting 249,000. And that, of course, shows that the labour market is still pretty tight. Another factor worrying investors is the debt ceiling. Janet Yellen has recently said that the US will run out of money on the 1st of June. That's just in a month from now. The Republicans and Democrats will no doubt negotiate a deal before then. But this is something that happens fairly regularly in America, these debt ceilings, and they force the Republicans and Democrats to sit down around a table and negotiate a deal before the debt ceiling is reached. Sometimes it gets quite exciting, and it does tend to impact the market. All right, just returning to the earnings figures for S&P 500 companies so far. They've been somewhat better than expected. This is especially true of big tech companies, which reported last week. The S&P rise on Thursday and Friday was driven mainly by big tech earnings. Microsoft and Apple now account for about 14% of the S&P 500's total market capitalization. If you add in Nvidia, Meta, Amazon, and Alphabet, so that would be 6 shares altogether, they make up 25% of the S&P 500's market capitalization. In fact, Microsoft and Apple alone have added more than $1 trillion to the S&P 500's value this year. This is equivalent to about half of its total gain over that period. But if you look at the price-earnings ratios, they are quite revealing. Microsoft is on a PE of 28, Apple is on a PE of 27, and Alphabet is on a crazy PE of 38. They look pretty fully priced to us. Overall, so far, S&P 500 earnings are down 1.9% compared to last year. But this is much better than the 5% down which was anticipated in April 2023 so far. So analysts, economists were expecting earnings to be down by 5%, and in fact they're only down by 1.9%, and that's a positive factor. In our view, the cumulative impact of rate hikes will be felt mainly in the second half of this year. As previously indicated, the S&P 500 will not penetrate the 4170 resistance level significantly. If you look at the chart, you can see the S&P 500, it's bumped its head there in February this year, and then again just a few weeks ago on the 18th of April, and now we've had it teetering around that level in the last few days. But it has fallen back from that now, and we think it will not penetrate the 4170 level. In fact, we're expecting it to fall back and ultimately test the low that was made on the 12th of October last year at 3577. But it is important to understand that Wall Street is now dominated by a generation of first-time investors. These are people who have no personal experience of a bear trend, and they are addicted to buying the dip. They always believe that the Fed will come to their rescue. They believe that a major recession in America is now politically impossible. However, in the current situation, the Fed has got a big problem. They may not be able to reduce rates, especially if inflation remains stubbornly high, which it looks to be doing. Bank of America is predicting that the recession will begin within weeks. When Wall Street falls, then other stock markets around the world, including the JSE, also fall. So you have been warned. Do not get swept up in the euphoria which is sweeping markets. If you still hold shares, make sure that you have a strict stop-loss strategy. All right, while we're still on the subject of America, I'd like to just talk for a bit about this de-dollarization process which is being talked about in the media. There have been quite a few reports in the media that the US dollar is going to lose its status as the international currency of choice. We believe that that is unlikely. It may happen in years from now or in decades from now, but it is not imminent because there is simply no other currency that can take its place. The yuan, a Chinese currency, is still basically pegged to the US dollar for its valuations anyway. A currency which was to be invented by the BRICS nations would take years to get this kind of acceptance worldwide. One of the most interesting charts to look at is a chart of the US dollar against the euro. So I'm just going to call that chart up for you. All right, let me put a bit of data on the screen here. Say 10 years, even pull in a bit more. All right. What I'm trying to show you is that the US dollar has been strengthening against the euro for the last 15 or 16 years. That's really what I'm trying to show you. As you can see, the trend is generally towards more strength. If we go back 15 years to 2008, you can see that the euro was trading at about 63 euros to a dollar. Sorry, 0.63 euros to a dollar. Today, it is trading for 0.91. So it's actually weakened substantially by about 50% over that period of time. The euro is really the only other currency that could conceivably be replacing the US dollar as the international currency of choice. And we don't see that happening. So from an investor's perspective, the dollar is probably going to remain dominant for the foreseeable future. All right, let's turn our attention now to South Africa. 2023 is becoming the year when South Africans finally accepted the reality of load shedding. It has become clear now that the government cannot resolve our power problems. Despite all the government protestations and excuses, Eskom is basically dying. It will be replaced, and it is being replaced, by private enterprise. All that remains is to see exactly how this process plays out. The ANC has consistently failed to resolve the power problem since 2008 when we had our first load shedding. Like education or healthcare or security, it is another area that will be taken over by business and managed by business. In fact, every board of directors in South Africa is currently planning alternative power solutions. Some are already far advanced, others are just getting started. As a private investor, you need to consider exactly where each listed company is, especially the companies that you are interested in. Have they got an alternative power system? Are they investing in solar? What is their plan to get off the grid? And this, of course, like the exposure to the rand or their exposure to union action or working capital problems, becomes another criterion that you have to apply to those shares which interest you. The resounding message, though, of the last 6 months is that it's not going to get any better. That is the message. In 1994, Eskom was one of the cheapest and most reliable power sources in the world. Today, it is only able to achieve an energy availability factor of 54% of its capacity. We are regularly at stage 6 load shedding, and that means that the power is off for 10 hours a day. It's also increasing its price by 3 times the inflation rate, and it's basically bankrupt, sitting with a debt of 420 billion rand, half of which must now be paid by taxpayers. And in fact, this is closely linked to the steady erosion of the ANC's support base in this country, and obviously to other service delivery failures. However, we believe that there is some good news. Despite all these negative developments, the ANC seems to be belatedly implementing solutions that will probably solve the problem. The latest bid window for renewables is for 14.7 gigabytes of power. That's about 1/3 of Eskom's existing installed capacity. Tax incentives have been put in place for both companies and individuals to encourage them to move away from Eskom. This will accelerate South Africa's move towards new renewables and away from coal. Eventually, that will be a very positive development for the economy. It will reduce the cost of power and make it far more reliable. We will not be in the hands of a single state-controlled monopoly. Okay, let's look at some other news coming out of Eskom. The Minister of Electricity, that has recently been appointed, wants to slow down the retiring of coal-fired power stations, and this has been approved by the ANC's National Executive. Obviously, it will have some short-term benefits for load shedding, but it endangers the $8.5 billion funding for the just energy transition that has been agreed with European nations. It could, of course, be seen as a populist move to try and garner support for the ANC in the next election. Eskom produced a pre-tax loss for the year to the 31st of March this year. It's expected to be around 32 billion rand. It's double last year's loss. And that is mainly because of declining sales and rising costs. But it proves once again that Eskom is not viable. The only bright spot in those results is that the transmission company seems to have been finally separated from Eskom, so that is a step in the right direction. The Treasury's move to exempt Eskom from reporting wasteful expenditure for the next 3 years looks like a move in the wrong direction to us. And we are not in favor of that at all. They must be required to report. Reporting is the basis of everything. And then we noticed that the theft of steel from pylons by organized crime syndicates resulted in 7 of these pylons collapsing, and large parts of Pretoria East and Mamelodi have gone without power. The industrial areas of Silvertondale and Voltlu are cut off from the power. The Ford factory, which employs 4,600 people, was brought to a standstill. Many other factories in that area also have not been able to have power. This, of course, is not good for the President's efforts to encourage foreign direct investments. On a smaller scale, a much smaller scale, load shedding has caused 66% of spaza shops to reduce their staff, according to Nedbank. Spaza shops actually employ about 2.6 million people in this country and contribute about 6% of gross domestic product. Many of them cannot afford generators. So this is one of the other effects of this load shedding situation. All right, let's turn our attention now to the economy more broadly. The consumer price index rose by 7.1% in March, driven mostly by higher food prices. And that's strange because food prices worldwide have been falling. But the rise in local food prices is probably due to the companies that manufacture food implementing new power solutions to get off the grid and to get away from Eskom. The Reserve Bank says that the consumer price index will be inside the 3 to 6% target range by the fourth quarter of this year. I guess we'll believe that when we see it. We expect rates to be raised at the next MPC meeting on the 25th of May by a further 25 basis points. So far, the Monetary Policy Committee has remained well ahead of other central banks on interest rates. It has resisted political pressure to debase the currencies. The rand has remained strong relative to other emerging market currencies, and here I would draw your attention to Argentina, which currently has inflation of over 100%. Fiscal discipline has also been maintained in this country. The 37.4 billion rand that is now needed to pay to the civil servants on their 7.5% wage increase has got to come from departments' existing budgets according to the Treasury. So it will not affect the debt consolidation targets. But SARS tax collections are shrinking. In the year to the 31st of March this year, they were below target. Load shedding is estimated to have cut tax collections by about 60 billion rand. The budget deficit, however, should still come in at about 4.5% of GDP, which is roughly what was in the February budget this year. Companies, of course, are taking advantage of the tax breaks for installing solar power. Mining companies, tax collections are down 5%, mainly due to the drop in commodity prices. But it's interesting to note that the top 10 solar panel importers paid a total of 3.8 billion rand in tax this year. President Ramaphosa's investment conferences are very difficult now. Load shedding has turned investor sentiment negative internationally. The goal, of course, was to raise $2 trillion in 5 years. Perhaps a large investment in renewables and the building and installation of renewable energy will help. In March month, manufacturing weakened further according to the ABSA PMI and also Stats SA. Sales of new vehicles also fell in March, probably due to higher interest rates. But nonetheless, 50,000 vehicles were sold in March. So it was still a strong year. The year to March was still strong. But the EFF's national lockdown did have an impact and negatively affected vehicle sales, as did the load shedding, of course. The post office has finally been placed in provisional liquidation by a creditor. Can you believe this? It's been technically insolvent since 2013. And this year in the February budget, it was given 2.4 billion rand by the Treasury as a bailout. The liquidation will be made final on the 1st of June unless someone stops it. In our view, this organization has got no useful function in this country at all. Average pay levels in South Africa are down 11.4% this year on last year. This is probably because people who lost their jobs during COVID were re-employed at lower salaries. Average monthly pay was 16,370 rand this year, which is about 2,100 a month less than it was in 2021. Okay, now I'd like to just quickly look at the rand, because obviously rand is very important. Its strength against the US dollar is very important to all investors here in South Africa. Okay, there's the chart. Just got a few things to say about this. The rand remains in a weakening trend, as you can see here, this weakening trend which I've identified. And this is due to two things, one local and one international. So the local factor, of course, is the load shedding, and the international factor is the risk-off sentiment, which is basically slowly taking control in Wall Street. The Monetary Policy Committee continues to keep rates attractive to overseas and bond buyers. So they are interested in our government bonds here because they offer a very good return. But of course, the endemic load shedding is scaring away would-be investors. The rand has weakened as the S&P rose last week. That's unusual. Usually the rand strengthens when the S&P is getting stronger, but last week it didn't, and that probably means that the S&P is going to fall. There's been a movement of smart money out of the S&P 500 and into the rand. because obviously those investors are looking for the high returns they can get on our South African government bonds. All right, I want to now look at some commodity prices, basically start with the oil price. Okay, let's have a look here. There you can see the oil price, the North Sea Brent oil. At the last confidential report, we talked about this breakout here, where it had broken up through this long-term downward trend line. As you can see, it went up after that, but now it's been trending down. Possibly the Biden administration has put more pressure on Saudi Arabia to bring those oil prices down. In any event, it looks like it's now at or breaking down through this trend line again. Trend line normally becomes a support line. So after a break up, you normally find the price will come back to the trend line as a support line. Maybe that's what's happening here. In any event, a falling oil price is obviously good news for monetary policy committees around the world, both here and in America, because it means inflationary pressures will be lower. And obviously it's not good for Russia. And that may be the reason that it's falling. Okay, let's look at the gold price. In the last two confidential reports, we have talked about the opportunity in gold. And I think it is a very important thing to be aware of. Just going to put some more data on the screen here. Okay, I'll just take it back to COVID-19. Okay, there's COVID, as you see on the left-hand side of the screen. And then what you notice here is that there's a resistance at this level of around $2,050 per ounce. So this is in US dollars. What we are seeing now is that there's a bit of a sell-off taking place right now. I'm trying to put that on the screen for you. You can see that there's an upward trend in the gold price, and that we've hit that high level there at around 2,050, and we are bumping our heads again. There's been a slight sell-off, but I noticed that last night there was a very strong upward move again in gold. So we believe that gold will break above this 2050 level, above this resistance here at 2050. It's in fact been one of the best investments in the world over the last 18 months, and that's obviously because some international investors are concerned that equities are overpriced. They're expecting the bear trend to resume, and some of them are putting their money into gold. That's why the gold price is going up. So we also expect the bear trend to resume, and so we believe that gold does represent an opportunity, either the bullion, gold bullion or Kruger rands, or the shares, certain shares, and we'll talk more about that in a moment. So as the S&P 500 falls back from the resistance level at 4170, we would expect the gold price to rise. In fact, we're expecting gold to reach $2,300 next year sometime. Okay, now I'd like to just look a little bit at Bitcoin because it is very much in the news. You probably know from following us in the past that we're not very favorable towards cryptocurrencies. We tend to take the same approach as Charlie Munger and Warren Buffett. These things are not investments. They're just a fad, really. But just to keep, I know that they're very popular, so let's just have a look at them. As you can see here, you can't really evaluate cryptocurrencies on their fundamentals because they have no fundamentals. So the only way you can really look at them is through the charts. And what the chart is showing us is that there's a significant resistance level at around $29,000. And you can see this recent uptrend that we've had this year in cryptocurrencies, which, by the way, coincides with the upward movement on the S&P 500, has found resistance there at around that level, $29,000 per coin. So now we believe that it will fall back from this level as the S&P 500 falls back from that 4170. So our advice, as usual with cryptos, If you have them, sell them. If you don't have them, don't buy them. Now, we know that the world economy and South Africa are beginning to feel the effects of higher interest rates. It's impacting on both consumers and businesses. Some economies, like the American economy, are still growing, but at a slower pace. We, however, expect the American economy to enter a recession before the end of this year. A world recession, of course, will be bad for commodities. But commodity exports are critical to South Africa. So you need to take these factors into account. You need to develop your own opinion about what you think is going to happen on the world stage and how it's going to impact on local shares. So the companies that we are interested in, rising interest rates have impacted on banks. Usually, rising interest rates are positive for banks because as rates go up, they still are financing the loans that they've put out there at lower interest rates, so they get a much bigger mismatch factor. But after a while, rising interest rates begin to result in higher impairment levels at banks. In other words, banks have to provide for more bad debts as interest rates go up. ABSA, for example, reported a 61% increase in its provision for impairments in the year to the 31st of December 2022. Other banks are in a similar position. Capitec is the most affected because it has given a lot of loans to lower income groups who are expected to be more vulnerable to interest rate hikes. Banking shares had a great year in 2022, but they may not do so well in 2023. On March the 27th this year, we published an article about the strong prospects for gold, and we explained the potential for a break above the resistance level at $2,050. Gold has not yet done this, but we still regard it as a very real possibility. The upward trend on Wall Street appears to be faltering. Some international investors will undoubtedly seek to protect themselves against the weakness in equities by putting their money into gold. So in this confidential report, we draw your attention to 4 gold shares, South African gold shares, with good potential. Not just gold shares, but precious metals and other commodity shares. All of these, of course, are commodity shares, and hence they tend to be more volatile and risky. The first one, what I want to talk about, is Sibanye. We think that this share is probably the most undervalued of the gold shares right now. I'll just put a bit more data on the screen here. You can see that it came down. It's made a serious double bottom over here in March and April, and now is moving up off that double bottom. This is a company which has accumulated a range of platinum and gold assets and is now adding what are called green metals, which are the metals that will be used in renewable energy and batteries. The CEO is Neil Froneman, who's known for his brilliance and toughness. He says that he intends to double the price of the company's market capitalization before he retires in about 2 years' time. He's involved in a massive share buyback program. Neil Froneman says Sibanye is cheap, and we agree with him. So there's an opportunity. Another gold share that's of interest is South 32. Now, South 32 was spun out of BHP Billiton in 2015, and it's been doing well. It's a diversified international mining house now, and you can see that since COVID, the share has been trending up very nicely. It's obviously volatile, but it has investments in base metals: zinc, coal, aluminium, silver, lead, nickel, manganese, those kind of metals. The company has just bought Arizona Mining, which the CEO, Graham Kerr, says is one of the most exciting base metals projects in the world. They also have a share buyback program. They're putting $1.4 billion into buying their own shares back. So we think this is a good opportunity too. The next one I want to talk about is Amplats. This is obviously the second largest platinum producer in the world, 77.6% owned by Anglo American. It is a low-cost, open-cast mining company with mines like Mogalakwena, which is in the lowest quartile of international producers as far as costs are concerned. It's a major palladium producer. It is, of course, being impacted by load shedding, but technically it's in a good position. As you can see here, it's recently made a double bottom in March and is now trending up again. So we think the share is good value at these levels. Finally, I want to just mention Kumba. This is obviously an iron and steel company or iron company. This is a very good share, very profitable. Again, you can see that double bottom. And here we've had a triple top and the share's trending up here. So we think that Kumba is a good operation. It's 79% owned by Anglo. 94% of its production is exported, which means that it is impacted by Transnet's problems. And we see the share recovering in due course. It looks relatively cheap to us. Okay, folks, that's about all I have for you this month, should I say. And just again, apologize for my voice, which is a bit croaky. And I'll talk to you again on the first Wednesday of next month. Thank you for listening.